pigs, you have to get all the pigs into a cattle chute and run them into the slaughterhouse and then slaughter them. You can't just let them, run around. You got to herd them up and get them into a cattle chute, or cows for that matter. And so if they want to slaughter savers and investors, they have to get you into a digital slaughterhouse. And that's what digital money is all about. If you can't have cash and you can only have the central bank digital currency, then everyone's got to have a digital account. And once they've got you in the system, of course, they know who you are because it's all digital and they keep the ledger. Back to the ledger. What can they do? Well, they can impose negative interest rates. So you have $100,000 at 1% interest. You go away for a year, you come back, you should have $101,000. But with a negative interest rate of 1%, you go away, come back in a year, and you'd have $99,000. Well, cash isn't an easy way around that. At least you bury it in your backyard, but at least you'd have the $100,000 in my example a year later. But with a digital account, they can actually take it out of your account. Number one. Number two, they can put a timestamp or an expiration date on your money and say, okay, here's your money that's in your account, but if you don't spend 10% of it in the next 30 days, we're going to impose a 2% penalty. We're going to take it away basically if you don't spend it. Oh, what does that do? It kind of forces you to spend it. Is that a kind of stimulus? Maybe, I'm not sure. These things don't usually work out as the eggheads plan, but the idea would be if we don't have enough what Keynes called aggregate demand, we'll force people to go buy stuff by telling them if you don't spend it, you lose it. Use it or lose it kind of thing. Okay. Withholding taxes. Now, again, in the United States, I think it's similar in Australia. If you have a job, quote unquote, your regular payday, whatever, they pay you, but they deduct the withholding tax at the source, and it's based on the rate. So maybe it's, 20%. So you make $1,000, they take out $200, and here's the $800 net to you. And then at the end of the year, they give you a statement, and you file your tax return, and you claim the withholding, and you reconcile your taxes. But that's not true for independent contractors, doctors, lawyers, professionals, writers, anyone who you earn a living, you work, right? But you don't have any withholding tax, but you still have the money still goes in your bank account. Well, now they can just impose the tax on your bank account. Say, well, hey, we see your inflows here. You make a nice living. We're going to take 20% of that. Again, send your tax receipt, and file your tax return and sort it out at the end of the year. That would come as a shock to a lot of doctors and lawyers. So negative interest rates and withholding taxes are two things that are hard to impose if in a world of cash and non-central bank digital currencies, but they're easy in a world of no cash and central bank digital currencies. Well, it gets worse. This is the culmination, just kind of cut to the chase. This is the culmination of the total surveillance state. We already have facial recognition software, very good. It's like your face is like a fingerprint. Everyone's a little different. You say, well, that's okay. I'm going to put a mask on because COVID, and sunglasses, and pull a hat down to my forehead. You'll never see my face. You know what? They have gait recognition software, GAIT, meaning how you walk. Everybody walks differently. It was that Monty Python thing, the mystery of silly walks? Well, silly or not, everybody walks differently. And so they can actually digitally identify you just by the way you walk. And so your mask isn't going to help you. And with GPS, I have a bunch of what are called Faraday sacks. They're, some of them are nice, they're leather wallets, but they're basically lined with a certain metallic fibers that block radiation. So if you want to turn your cell phone off, put it in a Faraday sack, and by the way, do the same with your Easy Pass and any other things sending out radiation, which are ubiquitous. Maybe they can't follow you around, but most people don't do that, and they do. And so with your iPhone, they know where you are at all times. You may be looking at a map trying to find a good restaurant, but they're tracking you. So they already do that. But now they take it a step further. So you're at the point of purchase, you're buying a book. Let's say it's a book that criticizes Kevin Rudd, for example. He's your leading panda hugger down in Australia, or in the United States, criticizes Joe Biden or something, or, Ultra MAGA hamburger, whatever it is. Well, oh, gee, ultra MAGA, you're an extremist, you're a radical, you're part of the insurrection. So now we're going to freeze your account or deny the purchase or put you on a watch list or we just appropriated money to hire 87,000 armed IRS, Internal Revenue Service agents. Maybe we'll assign one to you because you bought the wrong book. So now we're into thought control. We're into basically subduing your political enemies because what if you give money to a certain political candidate? Again, perfectly legal stuff. Buy a book, make a donation, that's legal. But they don't like who you're doing it with. And they meaning the government, they're watching. They know what you're reading and by inference, what you're thinking, who you're giving money to, what causes you support, et cetera, et cetera. And it doesn't take much these days to have some kind of low IQ spokesperson at the White House label you as an extremist. So this is all government's ever wanted, was total control of the people. Makes Louis the 14th look like a very hands-off kind of guy.
But Jim, the government would never do these things. That the tax office would never target a political group. They would never target a group of people because of donations to different causes. They would never target protesters in any way. They would never target someone who's doesn't want to get vaccinated in any way. None of these things would ever happen.
Well, I know you're being actually very serious, but I know that's more rhetorical. The fact is, not only will they happen, they have happened, they are happening. This is the world we live in. That's absolutely the case. And let me give some concrete examples because I don't put stuff like that out there without backing up. So in 2010, the IRS targeted what we call in the United States the Tea Party movement. This was the first midterm of President Obama's first term in office. Historically, a time when the president's party loses a lot of seats. It's not even Democrats versus Republicans. It's just a consistent pattern of first term president, first midterm election, they lose seats. Obama lost almost a record number of seats, something like 63 or 64 seats versus an historical average closer to 30. Because of people were upset about Obamacare, they were upset about the tax increases, the bailouts coming out of the 2008 global financial crisis favored the rich, hurt the poor. There was just a lot of people were having second thoughts about voting for Obama in the first place. So we had this Tea Party movement, and they just kicked butt in the 2010 election. Well, so these were springing up everywhere. This was a genuine grassroots movement. There was no nationwide top-down organization. Communities were like, hey, let's start our own branch of the Tea Party, et cetera. And because they qualified as nonprofit organizations, there's some rules around that, but you have to apply to the IRS, our Internal Revenue Service, for a designation and a number proving that you're a nonprofit organization. Well, the person in charge of those was slow rolling all the applications. They weren't getting approved. They were entitled to it. That the IRS intervened to squash the formation of Tea Party movements from coast to coast for political reasons, plain and simple. Well, that was 12 years ago, and there was no central bank digital currency. Imagine how much more powerful that kind of corruption is today. I think investors really should be prepared for the worst. I think I can keep this brief in the sense that a lot of what's going to affect the stock market is the geopolitical situation. But if you got a 401k and you're just buying the S&P 500 index from Vanguard or Fidelity, and it's been going up, and it has been going up, there's no question about that, and you're like, I'll just sit there and watch it go up, be careful. There's nothing I see that's going to make that better. And I remember the 1970s, the stock market peaked, Dow Jones peaked in 1969. It didn't get back to that peak until 1982. Now, okay, 1982 was the beginning of one of the greatest bull markets in history, grant that, but 69 to 82 is 13 years. It went sideways. Now, again, there's volatility and dips and peaks, and I'm not saying you can't make money, but I'm saying that there's a 13-year period when the stock market ended up where it started, number one, around 1,000 on the Dow. And when you adjust for inflation, because we had massive inflation like in the late 1970s, it was still down. So that's 13 years. The U.S. is heading into recession, and we may be in a recession. Everyone's like, wait a second, GDP was up 5%. And it was. That was the number for it was the first government estimate for the third quarter of 2023. It was up 5%, but it was very heavy on consumption and very heavy on inventory. So when those two things, well, consumption obviously, but people don't realize when wholesalers and distributors build up inventory, that counts as GDP. Well, it's fine to build up inventory if people are buying the stuff, but if they don't buy the stuff and you're up to the rafters in inventory, you got to start writing it down. This is where you see, you go to the Gap and you get like 10 shirts and 5 pairs of jeans for $30. I mean, this is what happens. They slash prices. They do 2-for-1 sales. They just move the merchandise, and particularly in certain areas, stuff goes out of style. The fashion industry is notorious. Who wants last year's, coat or whatever. So then the inventory situation comes down to the consumer. Are people buying stuff? It looks like the consumer hit the brakes in August. Now, the second quarter is July, August, September. Sometime around mid to late August, after 2 pretty strong months, and they were strong, the consumers just hit the brakes. A couple of reasons for that. Number one is during the pandemic, you go back to 2020, 2021, what was going on? Well, starting with Trump in, I think, June 2020, he gave everybody a $1,400 check. If you got a heartbeat, you got a check. And then Trump did it again in December 2020, just before he left office. It was another $600 check. Biden comes in and says, well, I can top that. And Biden does in February 2021, right after he was sworn in. Here comes another $1,600 check. And then there was Build Back Better, the Inflation Reduction Act, which is actually the greenest scam. I mean, we were spending we were running deficits of $2 trillion a year for about 4 or 5 years. The total spending was higher than that, but that was the deficit alone was about $2 trillion a year. Nancy Pelosi handing out money. Well, the Americans got used to that. Thanks for the check. And then there was a deferment on student loans. You didn't have to pay your student loans for about at least 2 years, maybe a little bit longer. And then when people got those checks, they saved a lot of it. So what happened in 2023? People drew down their savings. The savings rate got really low, like 3%. It was up around 13% during the pandemic. It's about a little over 3%, 3.5% right now, which is low. They spent the savings they had. They didn't make new savings. And then they turned to the credit cards and ran up their credit card balances. Well, that feels good for a while, but then if you're paying the minimum and rolling over the balance and you're at your limit, your credit limit's used up, and the interest rates are 20%, some of them are 28%, you're going to double that balance in 3 years. So if you're like, I'll just pay the minimum this month and I'll figure it out, your balance is going up because the interest is compounding faster than you're paying it down at 25, 25%. So people are tapped out on their credit cards. They've used up their savings. They're getting into a deeper hole because the interest is compounding faster than they can pay off the credit cards. And they're just backing away. And it's showing up in things like gasoline consumption. It's way down. Gasoline is what economists call, the demand for gasoline is what economists call inelastic, meaning you just have to buy it no matter what the price is. You got to take the kids to school or get to work or go shop, whatever it is. You're just going to buy the gasoline even if you don't like the price. By the way, lately prices have been coming down a little bit, which is that sounds good, but it's actually a bad sign because it's disinflationary, which kind of leans in the direction of a recession. But for gasoline consumption to drop, forgetting about the price, that means people are not driving. They're not going on vacation. They're not doing road trips. They're not driving any more than they have to. There are a lot of other signs. We don't have time to get into all the technicals with negative swap spreads and inverted yield curves and all the rest. But it does look like the consumer slammed on the brakes around late August, early September. You've got to be tuned into the geopolitics to understand the stock market. You can treat them as separate subjects, but if the world's falling apart, so that's not good for stocks. The funny thing now is that the highest yields in the U.S. Treasury market are in like a 6-month bill. Like, wait a second, shouldn't I get more if I buy a 30-year bond, or shouldn't I get more if I buy a 10-year note? It's a longer maturity, more stuff can happen, inflation, credit downgrades to the United States, bank freezes, all those things can happen. I want a higher interest rate for my longer term security. That's usually the way the yield curve looks. It's upward sloping. The longer the maturity, the higher the rate. That's not true today. The highest maturities are right around 6-month bills, 1-year bills, going out to 2-year notes. When you get to the 10-year note, you actually get a lower interest rate, lower what's called yield to maturity than you do on a 2-year note. So therefore, the next level of analysis is, well, what's going to happen to interest rates? Everybody wants to know that. In my view, they've peaked. they're going to come down. And I base that on what I said earlier about the economy. If we're going into a recession, we're going into a slowdown, we're looking at all kinds of geopolitical risks, stocks are coming down, then interest rates are going to come down too. But it's important to know that the world economy is slowing down. Germany is in recession. Japan is very close to it. UK, very close to it. Canada, I'm hearing nothing but, bad reports, housing market collapse, etc. China may not technically be in recession, but it's slowing rapidly. The thing with China, it's the second largest economy in the world. They've been growing at like 10%, 10% for over 20 years. When you compound something at 10% for 20 years, you're going to increase it by a factor of 10 or so over that time period, but not now. They're almost certainly below 5. They're going to print 5 because they make up the numbers if they have to. But when you strip out wasted investment, investment that, you build a massive train station with 128 escalators and marble walls, but nobody goes there and the tickets are $10. You can't pay for that. It doesn't produce any wealth. It just creates jobs. So the real estate sector is collapsing. That's been the biggest driver. People are not stepping out to buy houses. They're not taking the bait. Lower interest rates haven't helped. And so China's in a massive slowdown. Whether it's technically a recession almost doesn't matter, because when an economy that big slows that much, it drags the world down with it. So China's not going to save us. Europe's not going to save us. So it's a bit of a stretch to think the U.S. is going to dodge this bullet. If China's slowing down, Germany's in recession, Japan's getting close to recession, Canada, UK, emerging markets, the whole world, plus what we're looking at in the Middle East, the idea that the United States is going to boom while the whole world is going down is just not true. Globalization may be yesterday's news, but it's not over. The supply chains are still global, and we're seeing a lot of problems in the U.S. One of them, by the way, EVs, electric vehicles. People are waking up to the fact that they actually don't work. You can drive around in them, but they don't get the mileage they advertise. And, the resale value of Tesla is close to zero, because if you buy a used Tesla, the first thing you got to do is spend $10,000, maybe more, on a new battery. So you're like, wait a second, I bought a used car. I got to spend $10,000 to get a battery? Forget it. And the prices are sky high. It's all been subsidized by the government. So that industry is slowing down. The inventories are building up. It's part of what the UAW strike was about. And as I say, consumer hit the wall. So the U.S. is going to follow. The U.S. has been doing better than the rest of the world. The rest of the world's not doing well at all, and particularly China. And the U.S. is going to follow the world into this global recession. These are the early signs of a global liquidity crisis, which is different than a recession and different than called a plain vanilla, financial crisis. The liquidity crisis, is when you get ready to turn up the lights. There's a dollar shortage around the world, and people say, how can that be? The Fed printed, $7 trillion of money, M0, actually higher than that. I think we went up to 9 trillion. They just flooded the zone with money. And the answer is yes and no. Yes, they did print, over $7 trillion of base money, so-called M0. But that money didn't go anywhere. How does the Fed print money? Well, they buy bonds from dealers, from the big banks, the so-called primary dealers. So the open market desk at the Federal Reserve Bank of New York calls up Goldman Sachs. They offer me 10-year notes. Goldman says, here's a price. Okay, done. Goldman delivers the notes to the to the Fed, and the Fed pays Goldman. And that money comes out of thin air. That is money printing. But then Goldman takes the money and gives it back to the Fed as excess reserves. It doesn't go into the real economy. Nobody borrows it, nobody spends it, nobody lends it. All that happens is at the Fed, you're building up both sides of the balance sheet. You're building up the asset side with U.S. Treasury securities, and you're building up the liability side with deposits from the primary dealers in the form of excess reserves. So that money doesn't do anything. It's printed, if you want to say that, but it has not caused inflation. The inflation comes from, as I discussed earlier, from the supply side, the price of oil, supply chain disruptions, wheat, food, gasoline, et cetera. The inflation is flooding in, and it's exacerbated by fiscal policy. Now, you have to, what I just described about the money printing, that's monetary policy. Okay. But fiscal policy, which is the 5 or 6 or probably $7 trillion of deficit spending, that's helicopter money. When the federal government and the Congress and the Treasury hand out checks That's helicopter money. That's not like giving Goldman money and then Goldman gives it back to you. Forget that. It doesn't do anything. The minute it exists, it doesn't do anything. But when the government hands out checks, that's real. Now, some people saved them during the pandemic. A lot of millennials opened accounts on Robinhood and started trading cryptos. They could, kiss that money goodbye. But more recently, that money has been spent, and that's when the inflation really took off. So that was driven not by monetary policy; it was driven by fiscal policy. But getting back to the strong dollar, there's something else going on, which is the entire international monetary system is driven not by the Fed, but by eurodollars, by money that banks lend to each other so that they can support their balance sheets and lend to customers or offer transactions to customers if they will. And the main transactions is approximately $1 quadrillion of derivatives, options, futures, forwards, swaps, swaptions, I could go on and on. All of that, almost all of it, has to be backed up by collateral. I could say, if I'm a hedge fund and you're Morgan Stanley and I call you up and say, Addison, I want a $5 billion total return equity swap, which is basically a derivative basket of stocks. And I can buy and sell stocks all day long up to 5 billion, but it'll be notional. You'll pay me the profit or loss and dividends, but I don't actually own the stocks. I just have a $5 billion swap with you. And then you go out and maybe buy the stocks and hedge your position. You'll do that for me if I'm a big enough hedge fund or sovereign wealth fund or institution or whatever, but you want collateral. I don't have to give you $5 billion worth of collateral. I just have to give you enough, a little bit of foundation and the mark-to-market losses. So if I lose money on that deal, I will give you that much collateral. So collateral is the key to the whole quadrillion-dollar structure I described. So what's good collateral? Well, it used to be a lot of things, but today banks are saying to each other, we don't want your corporates, we don't want your stupid mortgages. We want 2-year treasury notes, maybe with a haircut, or 6-month bills, 4-week bills, 30-day bills, the best, absolute best, most liquid form of collateral. Well, okay. First of all, there's a scarcity of that. There's a collateral shortage, and banks desperate to prop up their balance sheets are asking, we're going to get some treasury bills. And they're bidding for them at prices that produce yields to maturity lower than what the Fed will give you for free. So if I'm a bank and I can call the Fed and the Fed will give me some treasury bills and I give them cash under an agreement to unwind that, and the interest rate on the cash is whatever, why would I go out in the market and bid on a treasury bill that pays me less than what the Fed will give me for a phone call? Why would you do that? The answer is you need the bill. In other words, you don't need an expanded balance sheet. You don't need more credit at the Fed. You need that bill to pledge as collateral on this quadrillion dollars of derivatives. And that's what's happening. So how do I get a bill if I'm Deutsche Bank or Credit Suisse or UBS or UniCredit or Barclays or anybody else? I need dollars. Because the bills are denominated in dollars. So if I want to buy them, I got to get some dollars. So there's this huge bid for dollars that can be used to buy the treasury securities, to pledge as collateral, to prop up the balance sheet. And that's what's going on behind the curtain. That's the plumbing. That's why the dollar is strong, even though everything about the US economy is weak, meaning recession, long-term depression, deficits, trade deficits, political dysfunction, borderline civil war. It's all bad. But if I'm Deutsche Bank, I need those dollars to buy treasury bills to prop up my balance sheet. But if you can't get it, or you can't get it at a price, or the dollar gets too strong, et cetera, or the yields get negative, et cetera, what happens is, and this is happening, the banks are reducing their balance sheets. And it's just a matter of time, in my view, not guaranteed, but one could see a situation where suddenly some major player goes bankrupt. They can't meet a collateral call, or a bank gets in distress, or there's a run on the bank. Now we're back to 2008. This wouldn't look like 2020. This would look like 2008, except worse. The supply side we kind of talked about. So energy shortages because of the Biden energy policy, empty shelves, supply chain breakdowns, bottlenecks at the Port of Los Angeles, not enough truck drivers, higher fuel prices get passed along. I mean, there's everything arrives by truck at the end of the day. It could come by boat or train, but it's somewhere in that delivery chain, those transportation channels, there's a truck, and they run on diesel. And when the price of diesel goes up, the price of everything in the truck goes up, because you got to factor the delivery costs into the cost at the counter. So that's kind of what's going on from the supply side. Demand side inflation, what's called demand pull inflation, is mostly psychological. In those consumers get it in their heads that prices are going up for whatever reason. Maybe they actually are going up and they extrapolate from that, or they have other reasons for believing that. And so what they do is they pull demand forward. And I lived through this in the 70s. This was what was happening in the 1970s. You want to buy a refrigerator or a car, or, a new suit or clothes or anything. And you go, you know what? I better go buy it now, right now, because it's going to be, if I wait 3 months or 6 months, it's going to be a lot more expensive. So you do. But what you're doing, you're pulling all that demand forward, and it feeds on itself. Prices are going up because there's more demand, possibly combined with supply shocks. And then when the prices go up, it validates the narrative. It's like, oh, see, I told you, prices went up, better go buy more. And it just feeds on itself. So, but they're very different. So the Fed, it's one thing to say the Fed can't do anything about the supply side inflation. The Fed can't do anything about it. The Fed doesn't drill for oil. They don't drive trucks. They don't pilot ships, and they don't work farm equipment. They can't do anything about it. They can do something about the demand side, which is destroying demand. So now we're in a situation, by the way, we're not all the way to demand pull inflation yet. In the 70s, it also started on the supply side with the Arab oil embargo in 1973. Then there was a second embargo in 1979 from the Iranians. So those supply shocks did tip over into the demand side, and then it just has a life of its own. We're not at that point yet. We're getting dangerously close. We definitely have it from the supply side. It hasn't yet affected the consumer side of it. In fact, consumers are pulling in their horns. I mean, they say the cure for higher oil prices is higher oil prices. In other words, if the price goes up, people will drive less. Or if you lost your job, you might not be driving at all. So there's another way for those prices to come down, which is the high prices themselves destroy demand by themselves. And then that results in lower prices. And that is happening. We have seen inflation come down a little bit. I know it was higher than a lot of people expected beginning in the middle of last year, but they are starting to come down a little bit right now. But the demand side of it has not yet caught fire. But there is something else the Fed can do. They can destroy demand. So how do they do that? Well, raising interest rates. So what happens? Credit card rates go up, mortgage rates go up, new housing purchases slow down, car financing, leasing rates go up. So people stop buying new cars, et cetera. If you do that enough, you can destroy demand, but it's at a very high cost, because what are you doing? You're putting the economy in a recession. So can the Fed deal with supply side inflation? The answer is yes, by destroying demand and putting the economy in a really severe recession. So nice job, Fed. That's between a rock and a hard place. Let it go. And it'll take a long time to fix the supply side, or crush demand so much that it fixes itself, but at a very high cost. And the Fed is doing the latter. It's a very, very imperfect, blunt instrument, but they are destroying demand. Now, so here's the policy question. Does the Fed know what they're doing? The answer is always no. They never know what they're doing. They pretend they do. They say they do, but they don't really. Do they understand what I just said? Not really. So what are they going to do? They're going to keep raising rates because they got to crush inflation. And that's what Volcker did. Leave aside whether that was really the problem, but that's what he did. So Powell is going to keep raising rates, and they may raise them 75 basis points in September, again in November, again in December, into 2023. And you're like, wait a second, Jim, you said we're in a recession and unemployment is going to start to go up, and there's demand destruction because of higher interest rates. And that may result in declines in housing prices. The inflation may cool off. So why is the Fed raising rates into weakness? And the answer is because they don't get it. They're always the last to know. And they're very political. Don't let anyone tell you that the Fed's not political. So here we have the situation where the inflation is coming from the supply side. Fed can't do much about it. They can destroy demand, but that'll throw us into a recession. So why are you raising rates into what may be both a coming recession and a global liquidity crisis, which we just talked about. The answer is that's crazy. You shouldn't do it, but it's the Fed, and they probably will. Sure. I would say, first of all, I would say we're in a depression right now. It will last for a long period of time. But a lot of people get confused, and one can understand why, about the difference between a recession and a depression.
Yeah.
Most mainstream economists, they don't like what I call the D word. They don't talk about depressions. They talk about recession. So a recession is conventionally defined as 2 or more consecutive quarters of declining GDP. And this would be the first back-to-back recession since 1980, 1981. So you have a recession, you come out of it, and then you go right back down into recession. So that's technical recessions. Depressions are different. And a lot of people think, well, if a recession is 2 quarters of declining GDP and a depression is worse, well, a depression must mean 10 quarters of declining GDP, as if it's a really long recession. And that's not the definition. The depression means depressed growth. Growth is depressed relative to trend, relative to potential. So you can actually have growth in a depression, but the point is the growth is too weak. And so this is what we're in. We had... the third quarter, when you went down that sharply, you were going to come back pretty steeply. That's natural. But we didn't come all the way back. People say, well, okay, you went down 31% and you went back up 33%. So aren't you back where you started? And of course, the answer is no, because you're applying the 33% to a smaller base. So if you normalize, let's say 2019 is 100% of 2019 output. You go down 5%, and then you go down 31%. Well, now you're around 65% of the prior output. Well, if 65 is the new base and you go up 33, that adds 21 or 22, but you're only back to 87 because you're working off a smaller base. Even if you have, in my example, 10% growth in the fourth quarter of 2020, it's 10% of 87, so add on 8 more. You're only back to 95. So a simple way to understand it, you fall into a 50-foot hole, you climb out 20 feet, well, that's good climbing, but you're still in the hole. You're not back to where you started. But a better comparison is maybe Japan. I would say Japan has been in depression since 1990.
Yeah.
Now, it doesn't mean, now they had growth and recessions and growth and recessions. You can have 2 or more recessions in a depression with periodic growth. But the point is you never get back to the old potential. I mean, good example, the Japanese stock index, the Nikkei index, in New Year's Eve 1989, it was 40,000. Today, 30 years later, it's about 28,000. But okay, it came off the bottom, but it never made it back to the prior high.
It'll never be.
Oh, I think that's right. It may never be. And another example, in October 1929, the United States stock market crashed, a very famous crash, but it lasted for 3 years. And when it bottomed in 1932, it was down 89.2%, almost 90%. That's what a stock market crash looks like. But then you ask people the next question and say, well, when did it get back to the 1929 high? How long did that take? The answer is 1954. Yeah. It took 25 years to get back to where. Now, it doesn't mean you couldn't make money in the meantime. You could have bought the low in 1932 and made money in 1933. But that's what depressions look like. That's the kind of thing we're in. This will be intergenerational. The effects of this will last for not 30 months, but 30 years. Wow. And there's very good evidence to back that up. There was a group, it was an economist at the Federal Reserve Bank of San Francisco and 2 academic economists. And they looked at all of the pandemics in the last 650 years, going back to the Black Death. I often criticize economists because their time series are too short. They say they're doing correlations and regressions. I was like, well, no, we need a much bigger time series. Well, 650 years is good enough. But they went back to the 1350s, to the Black Death, and they looked at every pandemic in which 100,000 or more people died. The fatalities were 100,000 or more. Of course, the 2 worst were the Black Death, the plague in the 1350s, and the Spanish flu around 1918, 1919. The Black Death was about 75 million dead, they estimate, and the Spanish flu was 100 million dead. And then after that, there were several where there were 2 million fatalities and some fewer. They were using 100,000. Well, there were only 15 pandemics in the 650 years where 100,000 or more died. COVID-19, by the way, is going to end up being third on the list. Right now, it's fifth, but we have over 1.8 million fatalities, but it's not under control. So you can see that number is going to go past 2 million. It'll pass the Asian flu, and there was one other influenza in the late 19th century. So it's going to be third on the list. But what they asked themselves, because they're economists, not doctors, and they said, well, how long did it take these economies to normalize following these extreme pandemics? And the answer is, on average, 35 years, not 35 months. And just to kind of give a concrete example of that. So I grew up in the 1950s and 1960s. It was a very prosperous time in the United States. I did not live through the Great Depression, but my parents did, and my grandparents did. So I was raised with a sort of depression mentality, even though I didn't live through it. And when we were little kids, 9 years old, my parents would send us that. We'd take our wagons and go door to door and collect tin cans and newspapers. And we weren't doing it for environmental reasons. It might have been good for the environment, but we were doing it for recycling, because all that stuff could be turned into buildings and so forth. And so, as I say, and that didn't change until the late 1960s, when the baby boom came of age, and then we just started partying and using credit cards and everything else. So it did change, but it took 30 years to change. In other words, the behavioral and adaptive effects of the Depression of the 1930s lingered through the 1960s. And that's my experience, but it's consistent with what these researchers found out. But at the end, when we get to asset allocations, I said the first thing I do is I explain my methodology and explain what diversification is. Diversification is a very powerful tool. It does what it's supposed to do, which is increases your total return with less risk. But people don't understand how to diversify. I run into people, they say, well, I'm diversified. I own 30 different stocks in 10 different sectors, technology, consumer non-durables, minerals and mining, et cetera. And I say, you're not diversified. You may have 30 stocks, but you're in one asset class called stocks. So when stocks are hard, they'll go up together. I'm not saying they won't go, they'll go up together and go down together. So you may have 30 stocks, but you're not diversified. Diversification is, okay, have a slice for stocks, that's fine. Gold, cash, real estate, treasury notes, and alternatives. That is closer to real diversification. So in particular, I recommend about a 10% allocation to gold. And people always want to put words in your mouth. They say, well, Jim Rickards says sell everything and buy gold. I've never said that. I don't believe that. But a 10% allocation, I think, is right. That will, if there is extreme inflation, that will produce gains that are so large, they'll kind of insulate the rest of your portfolio. So you're protected that way. And if there's a loss of confidence in the dollar or some kind of currency collapse, again, gold will do very well. I also recommend 10-year treasury notes, or for the German investor, bonds, 10-year bonds. And the reason for that is, first of all, they're high credit, they're liquid, but interest rates are going to go lower, which produces capital gains. It's a little bit counterintuitive. People don't understand bond math, but it's pretty simple. If interest rates go down, the value goes up. So as interest rates go down, you're getting more capital gains. So we have a lot of, very smart, very prominent people in the United States, Jeff Gundlach, Bill Gross, Dan Isaacson at PIMCO, and others who say, the interest rates are too low. This is the greatest bond market bubble in history. Short the bond market, et cetera. One by one, they've been carried out feet first. They've been wrong about that. And the reason is they confuse real rates and nominal rates. So nominal rates, that's the rate you see on television or when you look at a screen. That's the nominal rate. But the real rate is the nominal rate minus inflation. And the problem is nominal rates are low. That's true, but real rates are not low. I borrowed money in 1980 at 13%. That was my first mortgage. My mother cried because her first mortgage was 2%. But I said, Mom, I'm borrowing at 13%, but inflation was 15%. So my real rate was -2. Plus taxes were 50%, 50, and my interest was tax deductible. So I got a tax benefit on the money I was paying of 50% on the 13%. So that's another 7%, 7.5%. So my after-tax rate, after inflation, after taxes, my real rate was -8. So I was borrowing at 13 nominally, but my real rate after taxes and inflation was -8. That's a low real rate. But the point is that that's where we have to get to. If you want to stimulate the economy and borrowing and lending and spending and investment, et cetera, you have to get real rates much lower than they are right now. Well, we're not getting inflation, and eventually we may, down the road we may, but not now. Deflation is a greater danger. So if inflation is declining, we're getting disinflation and deflation, and the nominal rate is here. How low does the nominal rate have to go to get to a negative real rate? Well, it's got to go negative. It's got to go maybe -2 or -3. That will produce enormous capital gains for the bondholders. A trustless system. We're not going to trust banks. We're not going to trust clearinghouses. We're not going to trust exchanges. We're not going to trust central banks. We're not going to trust anybody. We're going to have a decentralized system that a community can validate, and we don't have to rely on anybody in particular. That was the original idea. So the question is, what's your method of validation? And that's what distinguishes one blockchain from the other. So I've listed 4 of them here, but there are others. Proof of work, that's what blockchain uses. And you know what the work is? You got to like factor these, 87-digit prime numbers into prime factors. It's a lot of computer crunching, completely clunky, completely inefficient, non-sustainable. I'll talk about that in a second, but that's Bitcoin. There's something else called proof of stake, meaning you actually, this is what Ether is based on, you demonstrate that you have a certain percentage of the processing power, so you step up based on your stake. There's proof of space. Space is storage space on a hard drive, so I get to vote on the blockchain. I get to vote on validating the blockchain because I've decided to devote a certain amount of my hard drive to that process. There's a new coin called Space Mint. And then there's the Byzantine Agreement, or Byzantine Agreement. There's a version of that called the Federated Byzantine Agreement, which I personally think is the best, much more robust to some of the problems we're talking about, and there are others. But the point is, don't talk about blockchain. Say, okay, what's your governance model? What's your validation model, et cetera? And then ask yourself, is that sustainable? Is that robust? Will that resist an attack? Are your cryptocurrencies going to be stolen? These are the questions you have to ask yourself, and there are no generic answers. So I cannot emphasize enough. Coin by coin. I hate to use the word coin, whatever, token by token, blockchain by blockchain, be rigorous and ask yourself what's sustainable. Now, Bitcoin, Ripple, and Ether, and some of these other cryptocurrencies, not all of them, but the best known are going to fail. When I say fail, they're going to, Bitcoin might have a $200 value as a token for criminals. I think criminals and terrorists might find a use case at about $200 per Bitcoin, but they're basically not going to be anywhere near where they are today. Why do I say that? I don't want to make a claim without backing it up. The first point is they're non-scalable. Transaction times are slow, and then when you say that to Bitcoin people, they go, aha, the Lightning Network is right around the corner. Lightning's going to, we'll see. They said that about segregated witness. They said that about some of these other solutions. They don't seem to get community support. They keep forking the Bitcoin, meaning one day you wake up and there's 2 blockchains instead of 1, or whatever happened to that whole idea that we weren't going to have inflation, and we weren't going to pull new cryptos out of thin air. But these solutions, you have to understand what the solution is. So what they're saying is, nobody has a solution for the inherent slowness, clunkiness, non-scalability of the original Bitcoin blockchain. There's no solution for that. So when you hear about solutions, what are they? Well, what they're saying is take a bunch of transactions offline. So everybody in the room could form a group, or let's say every coffee shop in Brooklyn, New York, or every coffee shop in Vancouver could form a group. And all the people who want to buy coffee would join that group. And we would agree, so we're in our own little bubble over here, and we would agree that all of our Bitcoin transactions among each other don't go on the blockchain. They just get settled in this sort of separate cloud over here, and then we net them out. So, I pay you 5 Bitcoin, and you pay the person next to you 4, and he pays the lady in the back of the room 10, and she pays me 7, and we net it out, and then periodically, and it could be daily, weekly, monthly, or whatever, we net all this stuff out, and then we take that net and we put that on the blockchain, so that the amount of transactions that have to go on the blockchain is greatly reduced. That's true. But what are we doing? We've created our own network. I got to trust the coffee shops. How do I know they're not going to steal my money? In other words, it's only a solution because you're completely negating the original idea.
Oh, well, sure. If you want to tear up the original idea and start over, that's fine. But don't tell me you're adhering to the idea of a decentralized, trustless network, because you're not. All you've done is create another network. Somebody, I get trolled on Twitter all the time. People tell me I'm an idiot and I don't know technology and all that stuff. And then my more sour moods, I tell them I was coding before they were born. But as far as some of these things are concerned, somebody said, well, you don't understand payment channels, and I actually do. And I said, yeah, I understand payment channels. We had those in the 50s. They were called party lines, which is, you pick up the phone and someone's talking, you got to ask them to get off the phone so you could go. In other words, there was an AT&T network, at least in the United States, but other people could jump in on this little side thing. That's all it is. These are party lines. So that doesn't work. Non-sustainable. The energy usage to solve the problem and make the proof of work in Bitcoin is now greater than the annual energy output of Ireland. Imagine taking all the electricity used in Ireland in a year, and that's how much we have to use to crunch numbers. By the way, every applied mathematician will tell you that prime factoring is a trivial problem. It's like an uninteresting problem. But it takes a lot of computing power to do it because the numbers are so big and the possibilities are so great. So we're just wasting the entire electrical usage of Ireland. In a few years, it's going to be the entire electrical usage of Japan. Who in this room thinks that governments are going to allow Bitcoin miners to use as much electricity in a year as the entire country of Japan, the third largest economy in the world? That's not going to happen. It's not going to happen. It's not very green. It's completely wasteful. In other words, it can't happen. So that's why I say it's non-sustainable. It's going to hit a wall. Non-regulated, I don't have to remind you of all the frauds, new ones popping up every day. And it's not just exchanges. How do exchanges work? I want to go to a Bitcoin exchange. Well, you got to go in, you got to open an account, just like Merrill Lynch or Charles Schwab, right? So, or Toronto Dominion. So you give me your name, your address, your social security number, your bank wire information, give them all that information, and then send them dollars. And they say, okay, you got some Bitcoin, here's your confirmation. Really? How do I know you didn't just take my dollars and send me a phony baloney confirmation? How do I know you're not, a Ponzi? You're using new money to pay off the old money. How do I know you're not Bernie Madoff with a computer engineering degree? How do I know you're not a bucket shop? How do I know any of those things? The answer is you don't. So good luck with that. Not to mention Bitcoin whales. They estimate there are 1,000 people who control 40% of the Bitcoin. Now you got millennials buying, 1/100th of a Bitcoin for, $10 or whatever the math is, $100. But you got these, I call them the whales, these 1,000 people who have 40% of all the Bitcoin. You don't think they have a big vested interest in keeping the price up? And you don't think they wash trade, do wash sales? So A sells to B for 10,000, B sells back for 11,000, A sells back for 12,000, B sells back for 13,000. This is called painting the tape. It's the oldest trick in the book. And there's no profit and loss because we're selling the same Bitcoin back and forth. But what we are doing is creating a ticker that gets the millennials, I shouldn't pick up millennials, 3 millennial children, but gets people all over the world, maybe a garage mechanic in South Korea took out a home equity loan or hawked his inventory, put his entire life savings into Bitcoin and has now been wiped out and is desperate and suicidal. That's what's going on. It's basically rich people stealing from the poor. Not a good business model in my view. And then finally, there's no use case other than criminals, terrorists, or tax evaders. Why is Bitcoin better than Visa unless you're a criminal? Now, if you're a criminal, I get it. If you're buying child pornography, you want to use the dark web and use some cryptos and all that. And if you try doing that with Visa, you'll probably get a call from the FBI. So I understand why it's good for criminals. But if you're not a criminal, if you're not a tax evader, if you're not buying child pornography, if you're not an arms dealer, if you're not a terrorist, then why is Bitcoin better than Visa? There's really no use case for it other than crime. And then it's non-elastic. And this is important because there's a finite number of Bitcoins, 21 million Bitcoin. They're getting closer to that level every day. And everyone's like, this is a good thing because, the problem with central banks is they print all this money and we're going to have inflation. By the way, we haven't had any inflation for the last 8 years. Separate issue. I'll come to that if we don't run out of time. But, we hate central banks. They print too much money, blah, blah, blah. So we're going to cap the number of Bitcoin. But money supply has to be elastic. It can't be too elastic. The problem with central bank money is that it's too elastic. The reason, by the way, gold is such a good form of money is that it grows slowly. It grows at about the tempo of world growth. It grows at about the tempo of population growth, not exactly, but close enough that it's the best form of money anyone's ever discovered. But the problem with Bitcoin, when you hit a hard stop, which they will, and the economy keeps growing, but you want to back it with Bitcoin, so here's your money supply and here's your economy, that's inherently deflationary, right? Because each Bitcoin's got to support more and more growth, meaning your Bitcoin is worth more in theory. But the problem is you never get there. Why? Because if you have a deflationary currency, there's no bond market. The money supply grows based on credit, based on loans, based on various forms of borrowing. The money supply is just a foundation, and the economy grows with credit. Nobody wants to borrow in a form of money that's going to be more expensive when you pay it back. I'm not talking about interest. That's always part of the equation. But I'm saying the money itself is worth more when you have to pay back the loan. No one's going to borrow on that loan, therefore no bond market, therefore no viable form of money. So these are all the reasons why this is going to hit the wall.
In 2014, Brisbane G20, there was an uproar. Citizens were, pardon my language, they were just pissed off. The taxpayers bailed out the banking system, and all the billionaires kept their jobs. So Jamie Dimon, he's still collecting bonuses, Goldman Sachs, all of them. None of them failed. They would have failed, but for the fact that they were all bailed out. But the everyday Americans are like, unemployment's 9%. I lost my job. I lost my 401ks down 50%, et cetera. So there was a political reaction to that. So in Brisbane 2014, they came up with not the bailout theory, but the bail-in theory. And right. Bail-in means that if a bank fails, the investors, the stockholders, the bondholders, the depositors, they have to basically pay off the creditors. They have to pay off the depositors, and only when there's nothing left would the government maybe chip in. So what? And they put the world on notice. The insured amount in Europe is 100,000 euros. U.S. is $250,000. But the whole world was on notice. That's all we cover. Over that, you're on your own. What the FDIC did on Friday was actually consistent with what they all said they were going to do in 2014. It was a bail-in. And if you had $1 billion deposit, you're going to contribute to the rescue. Within 48 hours, they did a 180-degree turn. They completely blew away the $250,000 insurance limit. They said, we're guaranteeing all the deposits, multi-billion-dollar deposits. By the way, a dirty little secret about what happened at the White House. I said that, the Silicon Valley billionaires were all crying about all these little startups and all this stuff. The truth is, a lot of what Silicon Valley Bank was financing was green technology, but they were in the White House sweet spot by saying green, and they were. That was actually what they were financing. Everyone thinks, oh, somebody's working on an app. They weren't apps. They was like battery power. So they get bailed out. At the same time, on Sunday night, now we're talking March 12th, they closed another bank, which was Signature Bank. Something about S, Silvergate, Silicon, Signature, all the S's were going down. Now, Signature Bank was another interesting case, which was Barney Frank was on the board of Signature. And if that name rings a bell, just think of Dodd-Frank. Dodd-Frank, 2010, 1,000-page legislation. I know I met Barney. I know Chris Dodd very well. That was supposed to solve all the problems of the 2008, 2009 financial crisis, et cetera. Here, the author of the bailout legislation is on the board of the bank, and his bank gets shut down. Well, what's up with that? They bought government bonds, and when interest rates went up from 10-year note, Treasury note yield to maturity went from 1 3/4 to 4. All those bonds lost 80% of the value. That's what happens on long duration bonds. Bond math is simple: rates up, price down, vice versa. Well, the rates were up, the price was down. So they were underwater and insolvent, and they got shut down. So Barney Frank's out whining the next day. He's like, hey, yeah, but that's true of every bank in the country. There's not a bank out there that didn't load up on Treasury bonds at 1 3/4. They're all underwater. They're all insolvent. And by the way, the Fed announced a facility, but basically what they said was, if you're a member bank and you have Treasury securities that are where the mark-to-market value is below par, so you paid $10 million, but they're only worth $8 million, and that was the case across the board. So they get trillion dollars or more of bonds that were in that category. You can deliver them to us, and we will lend you for 1 year the face value. So you're putting up 80 cents of collateral, but you're getting a 100-cent loan. I said, I got a 15-year-old car. Will you lend me what I paid for it? Because it's a lot more than it's worth now. But that's what they did. So now my head's spinning. I'm like, well, I get all this stuff, but I'm like, oh, so you just guaranteed every deposit in the banking system without limit, and you just guaranteed every treasury bond at par value without limit. What's left? Like, what else do you have in your bag of tricks? Because you don't have it. There's nothing else you can do. Go back to 2008, they guaranteed every money market fund in the country. So, but here's Barney Frank whining, hey, yeah, my bank was in trouble, but so was every bank in the country. Why did you whack me and give all these guys a pass? Well, the answer is Signature Bank was another crypto bank. It had a portal called Signet. And Signet was a portal to the crypto world. And that's why they whacked it. Notice they whacked 2 crypto banks. Everyone's asking Janet Yellen, it's like, wait a second, what just happened? You guaranteed every deposit in the banking system. And she's like, well, no, not really. It's only if you're systemically important. And you're like, okay, could you please define systemically important so we can tell? Because we're getting our money out of all the banks that are not. And the truth is you can't, because the system is so densely interconnected. And this is why they say financial contagion. I mean, it's a metaphor, but actually the mathematics of a viral spread, we just went through a pandemic, but this has been true, for as long as it's been studied. The mathematics of viral contagion are identical to the mathematics of financial contagion. The equations are the same, the way it spreads. And of course, Janet Yellen can't define systemically important. Number one, they try, but they can't. Number two, I don't care how small you are. If you're a small bank and there's a run, the guy across the street, he's getting his money out of that bank. And again, it's like COVID. It's like it just keeps going until the system collapses, which means by definition, just by the dynamics, there's no such thing as a bank that's not systemically important, because they're all connected. Even the little banks are borrowing from the big banks, et cetera. So Janet Yellen hemmed and hawed and didn't have a good answer. She never does. She's not that bright. And so there we are. So the Fed has guaranteed every bond at par value, even if you're worth 20% less. And the FDIC has guaranteed every deposit. And Janet Yellen can't give you a good definition of what's covered and what isn't. Okay. Now a week goes by. What's on tap for the next week? And again, Friday night press release, shotgun wedding, Credit Suisse and UBS. Now you're talking to big guys. These are 2 of the biggest, oldest banks in the world. I think Credit Suisse have been around since the 1870s, maybe, and I'm not sure about UBS, but they were the 2 biggest banks in Switzerland. So Credit Suisse fails, and they get taken over by UBS. Okay. And now everyone's like, oh, what's next? Who's next? And there's a list. I'll go through it in a minute. What factors come into play? How can I think about whether a bank is likely to fail or not, regardless of whether they're getting bailed out? And there are 2 metrics that are really good. One is look at the ratio of uninsured deposits to total deposits. If that number is more than 30%, you're a sitting duck. And in Silicon Valley's case, it was 97%. They were 97% uninsured. So a little local bank that's got, I'll say 30% uninsured and 70% insured, they're very unlikely to have a bank run. Most of those customers are like, hey, I'm covered, I'm good, I got 100,000 in the bank, all good. But when you're up north of 30, certainly north of 50, 70, 80, 90, you're an accident waiting to happen. Yeah. The other metric is total assets. So there really are too big to fail banks. Doesn't mean they can't fail, but it means they're 100% guaranteed to get bailed out. And that list is well known. So who's too big to fail? Like, you can put your money in, they can screw up really badly, and you're not going to get hurt as a depositor. JP Morgan Chase, Wells Fargo, Goldman, the usual suspects, Goldman Sachs, US Bancorp, Capital One, TD, State Street, Citi, B of A, Morgan Stanley, PNC Financial, Bank of New York Mellon, Truist Financial, and BMO Harris. They're the giants. Okay.
Right.
I'm not saying they can't fail. I'm saying that there'll be a safety net put under them, and no one's going to lose anything except maybe stockholders, but not bondholders, not depositors. The debt's not going up at 2% or 3%. The debt's going up 8, 9, 10% or more. The U.S. had a $1 trillion baseline budget deficit, $1 trillion per year deficit for fiscal 2020 pre-pandemic. The Congress threw $3 trillion of emergency aid on top of that. And I'm not even criticizing all those programs. I mean, the payroll protection plan loans, the extended unemployment benefits, the increased unemployment benefits. Imagine where we'd be if we hadn't done that. But that aside, debt is debt. They piled $3 trillion on top. Now, this is going to take the U.S. debt to GDP ratio up to 135%. It was 106% when Donald Trump was sworn in. It's close to 130% today. Because remember, you got two things going on. It's a debt to GDP. So debt's your numerator and GDP is your denominator, right? Well, what happened? Well, the denominator shrank. This got smaller and this got bigger. So what happens to the ratio? It blows up. So now it's 135%. If you get the laws of economics right, which is not easy because most economists don't, but if you get them right, it's really a reflection of human nature. I mean, what is an economy other than all the people in the economy starting businesses, buying, selling, traveling, providing goods and services, et cetera. So human nature doesn't change, or at least it hasn't changed much in the last 100,000 years. So the fundamental laws of economics don't change either, but circumstances change, facts change, and that's important. Now, to answer your question, Curry, you're right. There is a school of thought, a growing one, an influential one, that the debt doesn't matter. It's like, well, wait a second. So what? So the debt to GDP ratio went to 135%, which it did. Who cares? Well, what's wrong with it? 180%. We got issues. We got problems. Print up the money and monetize the debt and spend it and keep going. What is the problem? This comes under the banner of something called modern monetary theory, MMT. It's flawed, it's wrong, but it's got its followers, and those followers are now in the White House because one of the things Joe Biden had to do to get elected was to make peace with the Bernie Sanders wing of the Democratic Party. They take the view that if the Treasury didn't spend the money, how would anybody make any money? That's ridiculous, but that's what they say. They say, hey, when the Treasury spends money, what do? Well, they build aircraft. They have benefit programs. They have government contracts. They do whatever they do. But when the Treasury gives you the money, you take the money and you spend it on somebody else, goods and services, go out to dinner, have subcontractors, whatever it might be. That's the real source of money. They also take the Treasury and the Fed and they merge them. Now, that's not legally the case. The Treasury and the Fed are separate institutions. The Treasury is just part of the executive branch, and the Fed is an independent agency. And the Federal Reserve banks are actually privately owned. A lot of people know. Some people know that, some people don't. But the Federal Reserve banks are privately owned by banks in the districts, so Citibank, Bank of America, et cetera. So they're completely separate. But the theorists ignore that and say, no, the Treasury needs to spend money because that's how the economy grows, and the Fed can monetize the debt. So you spend the money you don't have, you borrow to cover it. You issue bonds to cover the borrowing. And if the market wants to buy the bonds, fine. But if not, the Fed can buy them and put them away on the balance sheet, wait 30 years and collect the money. What's the problem? Who cares about the debt to GDP ratio? It's kind of a statistical abstract, but why should that stand in the way of using money to solve our problems, which are free healthcare, free childcare, free tuition, forgiveness of student loans? That's a $1.6 trillion ticket, by the way. And look, everyday readers and investors, there's no reason they should know all this stuff. This is total inside baseball. You have to be a geek like me to kind of keep up with it, but it's all coming. But what that means is we're going to test the Rogoff-Reinhardt thesis. Now, let me just take a minute to explain that. Up to a certain debt to GDP ratio, there is a Keynesian multiplier greater than 1. So the classic example is the UK was in a depression before the rest of the world. They have been hit pretty hard before the Wall Street crash. People aren't spending, they're saving. It's the liquidity trap. So if you get money, you pay down debt. When you don't have any debt, you put it in the bank. Whatever you do, you don't spend it. You hoard cash. Or people were buying gold. They were accused of hoarding gold, et cetera. But what they weren't doing was spending. And there was a lack of aggregate demand, and the banks were not lending. So So Keynes said, well, if everyday people won't do it, the government must. The government can borrow, the government can spend. And what they discovered was that if you borrow $1 and spend $1, you can get $1.50 of GDP. Now, there's a separate debate as to whether that's actually incremental or whether you're just pulling growth forward. But so what? Even if you are pulling growth forward, maybe that's what you need to do when you're in a liquidity trap. But there's a problem. He called it the general theory of employment, interest, and money. But it was actually a special theory. I think he had a little Einstein in me because of the general theory of relativity. But it's actually a special theory, which means it's a theory that works in a set of circumstances, a set of conditions. The conditions where it works are you're either in a recession or just coming out of one. You have excess capacity and labor and industrial capacity, and you have very little debt. In those circumstances, you can borrow $1, spend $1, and get more than $1 GDP. The problem is that extra GDP you get for the borrow and spend, it goes down as the debt to GDP ratio goes up. What Reinhardt and Rogoff discovered is that at 90%, you go through the looking glass. Your payoff is now less than $1. You borrow $1, you spend $1, and you only get 90 cents of GDP or 95 cents, et cetera. So now, not only are you not getting your dollar's worth for the borrowed dollar or something more, which you did at lower levels, you're getting less than $1. So now what's happening? You're borrowing $1, you're spending $1, you're not getting $1 of GDP, but you are getting $1 of debt, which means your debt to GDP ratio is going up and the 90% is getting worse. And I just mentioned the United States is at 135%. So here are your two competing schools. There's the Keynesian multiplier and creating aggregate demand with government debt, and the Reinhardt-Rogoff, more than a thesis, I would say powerful evidence that beyond 90%, it doesn't work. It goes under less than one, on the one hand. And my friend Stephanie Kelton and Bernie Sanders and Kamala Harris and the modern monetary theorists who say, no, it's all good. How could you get growth if you didn't spend money through the government? These theories don't agree at all. We're going to find out which ones work. I'll give away the answer, which is that Reinhardt and Rogoff have it right. Keynes had it right up to a point. Reinhardt and Rogoff discovered that critical threshold, that whether you want to call it tipping point or phase transition, or which physicists call it or whatever. The modern monetary theorists think the opposite, and we're going to find out. But what it means if Reinhardt and Rogoff are right, and I'm right, and Keynes was right, the more you borrow, it's actually a headwind to growth. Now you get just as up to the threshold, you got more and more and more. Oh, sorry, at a low level, you got more, but then it went down. But it's like any diminishing marginal return. You know, the curve starts very steeply, you get a lot of payoff, then it flattens out, then it goes down, but it's still positive. But at some point, it goes below the zero line and your marginal return is negative. And that's where we are. But a global recession is highly unusual, and that appears to be what we're heading for. So my forecast, I do update them, but big picture, it goes as follows. So what is Jay Powell doing? First of all, March 1st, 2022, the Fed fund policy rate, interest rates were 0. And we're now at 4.5%. Even in the Volcker days, we never went up 4.5% in 10 months. Not that fast. And so here we are. So what is Powell doing? Well, he's given 5 speeches on the subject. I don't know why Wall Street doesn't listen, but he keeps trying. He said the same thing every time. He said, inflation is job one. We're just going after inflation. Believe us. There is going to be a recession. Unemployment is going to go up. There's going to be pain. I've never heard a Fed chairman use the word pain. He used it 5 times in one paragraph in the Jackson Hole speech. And that's what we're doing. And believe us when we say it. Now, how long will he raise rates? How quickly? And what's he trying to do? Powell is trying to get to something that he calls the terminal rate. But the definition of the terminal rate is it's a rate that's high enough to cause inflation to come down on its own without further hikes. So we'll get to a level, and then inflation is coming down, by the way. And in the last 5 months, in the U.S., it's gone from about 9% to 8.7, 8.2, 7.4, 7.1. So it is coming down. Having said that, the target is 2%. and 7.1 is still a far cry from 2. So he's not there, but he's making progress. Now, so here's I hate to use the word conundrum, but it kind of is. Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 50 basis points on February 1st, and then probably 25 basis points in March. March 22nd is the Fed meeting after that. So those 75 plus the 450 we have now, that'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation's coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think. And rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it. And you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message, why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. People forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly, kind of like a smaller version of what happened in 2020 with the pandemic panic. And then they said, oh, sorry, just kidding. And then they took the ceiling off and then things got back to normal. Now, this was a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building. And one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, and he said this in his last book, just before he died, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist, he's a lawyer, so he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder he never should have done. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question, so that's the lay of the land. There's the two competing sides. How does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, don't. If you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. So they think they have to keep fighting this fight. But here's what they're missing. Here's where it all falls down. Yeah, inflation as measured, CPI, PPI, personal consumption expenditure, core, non-core, year over year. There are like 20 different ways to measure it. It is coming down, but there are two sources of inflation. And it's going to sound obvious, but you got to separate them: the supply side and the demand side. They both result in price increases, but they have completely different dynamics. Supply side inflation is what we're seeing. It's what we saw in 1974 with the Arab oil embargo during the Arab-Israeli war when they cut us off from oil, and you had to line up for gasoline. I lived through that. Bare shelves, and you couldn't get certain things. It wasn't that every supermarket shelf was bare the way it was in East Germany in the 1950s, but something was always missing, and that's still the case today. So of course prices went up, and people were trying to pay whatever they had to get what they needed, and energy prices were a big driver of that. So that feeds through as a form of inflation. The other kind of inflation is from the demand side. So the supply side is called cost push. Costs go up and they push it onto the consumers. The other kind is from the demand side. It's called demand pull. And basically consumers have a change in mentality. They're worried about inflation. They would say, hey, I was thinking about buying a refrigerator. Gee, I better go buy it today because if I wait for 6 months, the price is going to go up. Or apply that to anything, a new dress, new suit of clothes, whatever. And so you're pulling demand forward, and it's behavioral. And that will also drive prices up. But they're very different things. Now, cost push can morph into demand pull. That's what happened in the 70s. It started from the supply side, but by the late 70s, 80s, and Volcker, which we've just been talking about, it had tipped over into the demand side. That hasn't happened yet. We've had the supply side inflation, the cost push. It hasn't yet tipped into demand pull. It hasn't really affected consumer behavior that much in terms of people anticipating more inflation. It could, but it hasn't happened yet. Here's why that's an important distinction. Cost push inflation negates itself. The old saying that the cure for high oil prices is high oil prices because people can't afford it. Maybe if demand is inelastic, if you got to fill up your Ford F-150 truck with gasoline to take the kids to school or go to work. But if you're unemployed, you're not buying any gas because you're not leaving the house. So it tends to negate itself, whereas demand pull feeds on itself. Powell has not made that distinction. And if I'm right, I think I am right, and the evidence backs that up, this inflation will come down, not because the Fed is raising interest rates, but because higher prices destroy demand all on their own. If I used to pay $75 to fill up my truck with gas, and now I have to pay $150, which is about right, I'll do it because I got to get to work. But that's $75 I'm not going to spend on something else. I'm not going to go out for dinner. I'm not going to go to a show, a concert, or buy a new camera, whatever it might be. So it does tend to depress demand, destroy demand, and hurt the economy. And then it slows down, and then the inflation comes down on its own. That appears to be happening. But Powell hasn't really made the distinction. He's fighting the last war. I hate to use a cliche, but he's fighting the Volcker War. And what he's got looks a little bit more like the Herbert Hoover War. That looks a little bit more like the 1930s than the 1970s. So the bottom line on all this is the Fed is going to raise rates at least twice more for the reasons I mentioned. Powell doesn't want to repeat the Volcker mistake. He thinks the battle's not won. He has to get to the terminal rate. In reality, he's probably already there, if there is such a thing as a terminal rate. It's another one of these things they made up. Inflation is coming down, and so will probably continue, but for really bad reasons.